This section will talk about asset disposition, whether we sell it, retire it, or potentially exchange it. So how do we account for the disposal of long-term assets? This slide shows 3 different ways an asset can be disposed of. Long-term assets can be sold, they can be retired, or they can be exchanged for other assets. A sale is the most common method to dispose of an asset. A retirement is when a long-term asset is no longer useful but can't even be sold. And an exchange occurs when 2 companies trade assets. In a trade, we often use cash to make up for any difference in fair values between the assets. To illustrate the recording of disposals, let's go back to our delivery truck example with Little King sandwiches. Assume Little King uses straight line depreciation and records the delivery truck in the equipment account. The specific details are summarized on this slide. So we've got some different examples. What if the truck is sold after 3 years for $22,000? Or what if it's sold after 3 years for $17,000? Or what if it's retired after 3 years? Or what if it's exchanged for a new truck worth $45,000 and a $22,000 cash payment? So we've got some various suggestions in how we'll handle them. If we assume that Little King sells the delivery truck at the end of year 3 for $22,000, we can calculate the gain as $3,000. The gain's equal to the sale amount of $22,000 less the truck's book value of $19,000. So you see how this calculation plays out. We would debit cash for $22,000. We would get rid of our accumulated depreciation to bring it down to 0. We would also want to get rid of our equipment account to bring that down to 0. And we would show a gain there of $3,000. We record the sale by removing the delivery truck and equipment and its accumulated depreciation from the accounting records and recording the cash collected. The difference is gain. Be careful not to combine the delivery truck of $40,000 and the accumulated depreciation of $21,000 and the credit the $19,000 difference to the equipment account. Instead, we have to remove the delivery truck totally, and then we have to totally remove the accumulated depreciation from the accounting records separately. Otherwise, the equipment and the accumulated depreciation accounts will incorrectly have a remaining balance after the asset gets sold, and we don't want to do that. Now, if we assume that Little King sells the delivery truck at the end of year 3 for only $17,000 instead of $22,000, we're going to have a $2,000 loss as shown on the slide. If, in this case, the sale amount is less than the truck's book value, so we record a loss on the sale. As you see here, the equipment depreciation, accumulated depreciation in the equipment accounts must be reduced to 0. The cash is a debit of $17,000. But to make this transaction balance, we would have a loss, a debit of $2,000. Now, we assume Little King retires the delivery truck instead of selling it. If, for example, the truck is totaled in an accident at the end of year 3, we have a $19,000 loss on retirement as calculated on this slide. The above entry assumes Little King did not have collision insurance coverage. If, for example, Little King had insured the truck and collected $17,000 in insurance money for the totaled vehicle, the entry would be identical to the sale for $17,000 as shown in the previous slide. But in this case, we do not get anything from it, so we would zero out the equipment, zero out accumulated depreciation, and the difference would be a loss. Here's a question for you. If an asset is sold at the end of its first year of use, which depreciation method would result in the highest amount of gain or the lowest amount of loss, assuming the asset is used fairly evenly over its useful life? So the question is asking us here, what method is going to bring this value, the book value, down as low as possible? Double declining, assuming that the asset is used uniformly, means the approximately the same amount of depreciation would be recorded for each year of the asset's life. The double declining balance would result in the most depreciation in the first year and therefore the lowest book value. A low book value results in the highest amount of gain or the lowest amount of loss. Now, let's assume that Little King exchanges the delivery truck at the end of year 3 for a new truck valued at $45,000. The dealership gives Little King a trade-in allowance of $23,000 on the exchange, with the remaining $22,000 paid in cash. We have a $4,000 gain as calculated on this slide. So the trade-in allowance is $23,000 less the original cost of the truck minus the depreciation. Our book value here would be $19,000. So we would have a gain of $4,000. We would show the new equipment as a debit, zero out the old equipment and its corresponding accumulated depreciation, credit the cash, and show the exchange equipment for a gain. If we dispose of an asset for more than book value, we record a gain. If we dispose an asset for less than book value, we record a loss. Here's an exercise 717. Abbott Landscaping purchased a tractor at a cost of $42,000 and sold it 3 years later for $21,600. Abbott recorded depreciation using the straight line method of 5-year service life and a $3,000 residual value. Tractors are included in the equipment account. Record the sale. So we would zero out the equipment account. Since equipment has a normal debit balance, we will zero it out by crediting equipment of $42,000. We would reduce the accumulated depreciation account to $23,400, which is the $42,000 minus the residual value, divided by 5 years would give us $7,800 a year, and we are getting rid of this after the 3rd year, so we would have $7,800 times 3 years of depreciation, or $23,400 in depreciation. So by zeroing out the equipment, the accumulated depreciation, and debiting our cash would show a $3,000 gain on the sale of equipment. Now assume the tractor was sold for $13,600 instead of $21,600. What would we do? Well, since it's being sold after 3 years, our accumulated depreciation is going to be the same, $23,400. But since our cash is $13,600, we would have a loss on the sale of equipment of $5,000. Next, let's discuss asset analysis. And we've discussed the purchase, the depreciation, and disposal of long-term assets. In this final section, we're going to see how to use actual financial statement information to analyze the profitability of a company's assets. This illustration provides selected financial data reported from Walmart and Costco for use in our analysis. Now, these two companies are close competitors in the discount retail industry. Walmart is larger, but is it more profitable? Walmart had net income of $16.4 billion and Costco had net income of $2.1 billion. Since Walmart's net income is so much larger, is Walmart more profitable? Well, not necessarily. Walmart is also a much larger company as indicated by total assets. Walmart's total assets were $203.7 billion compared to $33 billion for Costco. A more comparable measure is return on assets, or ROA for short, which equals net income divided by average total assets. The average is calculated, the average is calculated as the beginning amount plus the ending amount divided by 2. Dividing net income by average total assets adjusts net income for differences in company size. So the return on assets ratio is calculated for Walmart and Costco in this illustration. Return on assets indicates the amount of net income generated for each dollar invested in assets. With an ROA of 8%, Walmart generates 8 cents of profit for every dollar of assets. Costco's 6.5% ROA indicates that it generates 6.5 cents of profit for every dollar of assets. Even after adjusting for company size, Walmart is more profitable than Costco. We can explore profitability further by separating return on assets into two components, profit margin and asset turnover, as shown on this slide. Profit margin is calculated as net income divided by sales. This ratio indicates the earnings per dollar of sales. Asset turnover is calculated as net sales divided by average total assets. This ratio measures the sales per dollar of assets invested. So now if we compare Walmart and Costco, we might expect Walmart to have a higher profit margin and a lower asset turnover than Costco. Walmart's operating results include both traditional Walmart stores and their wholesale stores, Sam's Clubs. Costco focuses solely on wholesale stores specifically designed to offer lower prices to customers with higher sales volumes than traditional retail stores. Let's see if the data support our expectations regarding Walmart and Costco. This slide calculates the profit margin for both companies. Walmart's profit margin is higher than Costco's. Now this slide calculates the asset turnover for both companies. Costco has the higher asset turnover. These accounting ratios support our expectations regarding the business strategies Walmart and Costco are pursuing. So to maximize profitability, a company ideally strives to increase both net income per dollar of sales, which would be profit margin, and sales per dollar of assets invested, which would be asset turnover. Here's a question for you. Papa's Pizza has the following items for the past year. Net sales are $24,128. Net income, $2,223. Total assets at the beginning of the year are $14,898. And total assets at the end of the year are $15,465. What is the profit margin? We would compute it by taking net income and dividing it by net sales. So our net income of $22,223 divided by our net sales of $24,128 gives us a profit margin of 9.2%. We're going to identify impairment situations and describe this two-step process. So reporting for impairment losses is a two-step process summarized in this slide. Step 1, we test for impairment. The long-term assets impaired if future cash flows are less than book value. And then step 2, if impaired, do we record an impairment loss? The impairment loss is the amount by which the book value exceeds the fair value. Which is the overall financial statement effect of the impairment loss? The impairment entry reduces net income in the income statement and reduces total assets in the balance sheet. Management must review long-term assets for impairment. Impairment occurs when the expected future cash flows, which are expected future benefits generated for a long-term asset, fall below its book value, which is the cost minus depreciation. So as you see here, estimated future cash flows generated for a long-term asset fall below its book value. A trademark has estimated future cash flows of $20,000 with a book value of $50 and a fair value of $12. Is it impaired? Yes, because the future cash flows are $20 and the book value is $50. What is the amount of loss? The amount of loss would be the book value minus the fair value. So we would have a loss of $38,000 against trademarks of $38,000. Here's a question for you. An impairment loss is recorded when A, fair value exceeds book value exceeds fair value, C, estimated future cash flows exceed book value, or D, book value exceeds estimated future cash flows. Book value exceeds estimated future cash flows. Well, there you have it. We have completed this chapter. I hope you have understood the concepts and feel free to review this as many times as you need.